Everyone this afternoon. Today we're going to be talking about best practices for consistent income using options with options play. So today what we're going to do is we're going to go over some of the best practices for cover calls strategies on your portfolio. This is one of our favorite strategies because almost everyone here has some stocks that they have in their account, and you can use cover calls to generate some income on the assets that you already hold in your portfolios. And today what we're going to do is we're going to talk a little bit about cover calls, what they are, how you can use them. We're going to talk a little bit about the personal preferences that you have. But most importantly, we're going to show you what we have found from our testing to work over the last 10 years with cover calls. And ultimately what we want to do is we want to show you how you can utilize our tool, Options Play, to very quickly find these opportunities for your own portfolio and be able to easily implement these strategies on your the stocks that you own. So let's go ahead and get started. So I'll just leave this up for 1 second. If anyone's having audio issues, just please dial into the conference line. Like I said, today what we'll do is we're going to go over some of the backtesting results that we've created. So we've been backtesting the S&P 500 stocks over the last 10 years with all different entry and exit strategies, different expiration dates. So today we're going to share with you some of those results so you have an idea as far as what works, what doesn't work from our results. So I've already talked a little bit about this is what we're going to go over today, just some basics and benefits up front. So before I get started, for those of you that are new to Options Play, welcome. If you could just type into the chat window yes if you have traded cover calls or are familiar with cover calls, and no if this is a new strategy for you, just so I get an idea as far as who's on this call. Okay, so pretty much all yeses. Great. Okay, so we're going to skim mostly through kind of the basics and benefits of cover calls and really dive into a bit more related to the results and best practices for managing these. And lastly, like I said, we're going to end this with talking about some exit strategies as well as, most importantly, how you can use our tool to help you quickly identify income opportunities for your own portfolio. So, just a few of the basic benefits and limitations, especially for those of you that are familiar with this. I'm going to go through this fairly quickly. The benefits of cover calls: it generates a consistent income for your portfolio and lowers the net volatility and the net cost basis of the stocks that you own. And the best of all is it's used on stocks in your current portfolio. And I think the best way to think about this is when you own stocks in your account, you obviously want those stocks to appreciate in value over time. However, in the meantime, while you hold on to it and wait for that capital appreciation, what is that asset doing for you? If you have dividend-paying stocks, you're getting some yield from the dividends. But aside from that, you're really not getting much, and the only benefit that you're getting from it is in hopes that it'll appreciate in value one day. So if you think about cover calls, it's just one way to extract yield out of the assets that you already hold in your portfolio. Just like buying an investment property. You buy a property because you hope that it'll appreciate in value over time, but you also want to generate some yield or income in the meantime while you do that. And cover calls is a great way to go about doing that. And that's really why this is a strategy that's very, very popular, especially amongst investors, because it allows you to extract some yield from the portfolios that you already own. The limitation is that it limits the upside return of your stock. So it limits that capital appreciation when you sell a cover call, which is why understanding what works, what doesn't work is extremely important before you deploy one of these strategies on your portfolio. And that's some of the data that we're going to share with you today. Lastly, it requires a minimum of at least 100 shares of a stock in order to sell a covered call, and you do risk losing your stock at the strike price that you sell your call at, which is why, again, we're going to go through best practices so that you can understand what works. So talking about individual profiles, the cover call strategy is not a one-size-fits-all. Each one of you has different profiles and different risk tolerances. So I just want to go over the two things that's important to understand before you deploy cover call programs for your account. When you're selling a cover call, there's two things that you need to decide: expiration date and strike price. So in order to choose those two things, you need to first understand what suits you best. So when it comes to expiration dates, you really have to ask yourself, how often do I trade, or how often do I look at my portfolio? For some of you that are like me that have time to look at your portfolio on a daily basis, you would fall more on the short end of the spectrum when it comes to cover calls. So for those of you that are in that camp, you want to choose expiration dates that are relatively short dated, anywhere from a few weeks out to about 2 months out. For those of you that are long-term investors, meaning you might buy and hold on to it for years, if not decades, and you might look at your portfolio once a quarter or maybe once every few months, you want to be on the other end of the spectrum. You want to sell cover calls that are about 3 to 6 months out. But most of you will probably fall somewhere in between. You might look at your portfolios once a week, once every couple of weeks. You want to choose expiration dates that are generally 2 to 3 months out. So that helps you give you a somewhat of a guideline as to what expirations you should be taking a look at when you're selling cover calls. And next, when it comes to strike prices, we got to think about what's your risk tolerance. Each one of us is a little different. So understanding what the different risk profiles is important for you to help determine what's the best strike price for you to sell when you're doing a cover call. So on the conservative end of the spectrum, these are traders that are long-term investors where maybe you've held onto stock for a long time. Excuse me. Maybe you've held onto stock for a long time. You have a low cost basis on it. You don't want to lose that stock. Or perhaps you have dividend-paying stocks that you rely on that dividend for income. If you fall under either one of those categories, you would be on the conservative end of the spectrum when it comes to risk tolerance. So for that, you want to choose cover calls that have approximately a 90% chance that those calls will expire worthless. For those of you that are unfamiliar with probability of expiring worthless, that's okay. If you've ever traded options, you might be familiar with the term called delta. So a 90% probability of expiring worthless translates to roughly a 10 delta call. Delta is simply an approximation that we use for the probability of the call being in the money. So the inverse of that is simply what is the probability of that call not being in the money or out of the money. So if you're a conservative, you want to choose something with about a 10 delta call or a 90% chance of expiring worthless. On the other end of the spectrum, some of you are very aggressive when it comes to taking risk. You want to maximize the return of the trades that you make, and you're willing to take on some additional risk. If that's you, you want to choose something with a relatively lower probability of expiring worthless. So approximately 70% chance that that call will expire worthless, or in other terms, a 30 delta call. And then most of you probably fall somewhere in between, which is where I am. You don't necessarily have a lot of stock that you have a low cost basis on. You're not too aggressive when it comes to chasing yield. You fall somewhere in between. You're looking for a balance between risk and reward. If that's you, you want to choose stocks or calls that have approximately 80% probability of expiring worthless, or approximately a 20 delta call. So before we move on, make a mental note to yourself. Where do you think you fall in terms of the time frame? For me, I'm on the shorter end of the spectrum. And for risk tolerance, I'm on the optimal track. So I have short-term optimal settings for me on options play. And that's what we're going to show you once we bring up options play, how you can use these settings to help you quickly identify the cover call opportunity that best suits you. So how do we generate consistent income in your portfolio? And it's really quite simple. We talked about the two different things that you need to choose, which is expiration and strike price. So we talked about selecting an expiration date that suits your trading frequency. That's number one. Selecting a probability that fits your risk tolerance, which is selecting the strike prices based on your risk profile. And lastly, so once you follow those two steps, the only last thing you need to account for is once you've selected your expiration date and strike price, you want to check to see if the results of or the returns of that cover call, it gives you enough yield. And how do you determine whether something has enough yield? I like to use the dividend yield as my guide. So I usually like to at least beat the dividend yield on a cover call in order for it to be worth my while. What does that mean? It means if a stock pays a 1% dividend and I'm looking at a cover call that pays a 5% annualized return, then that's increasing my yield from 1% to roughly 6%. So that's certainly a trade that I'll entertain because it's more than increasing my dividend yield, which is I'm only getting 1% on the stock. Conversely, if you have a stock that pays a 5% dividend and you're looking at a cover call that only pays a 1% yield, then you're only increasing your returns from 5% to 6%. Not as good as a return. So use the dividend yield as your guide to determine whether it's worth your while or not. And like I said, as a rule of thumb, I usually like to beat the dividend yield on a cover call in order for me to consider that as a trade. So now that we've kind of gone over some of the basics of and the mechanics of a cover call and what things you should look for when selecting expiration dates and strike prices, what we really want to do is know what works, what doesn't work. And what we've done is we've back-tested 500 stocks, the S&P 500 stocks, over the last 10 years across lots of different ways of entering the trade, exiting the trade, different expiration dates, different deltas. And what we want to do is show you kind of what our findings have been. So talking about expiration selections, like I said, you have three choices: short, medium, long-term. Generally speaking, most people fall somewhere in one of those three camps. Now, when you're on the short end of the spectrum, just like with all options trading, it's all a trade-off. On the short end of the spectrum, you're going to get less premium. If you do a longer dated call, you're going to get more premium. But what are you exchanging for that? So when you're doing short dated calls, you generally speaking have more certainty. What I mean by that is when you're trading a 1 month call, you have a little bit more understanding of what might happen in the next 1 month than you do in the next 3 months or 4 months, because things like product launches, earnings announcements, shifts in the industry, news that are coming out. These are the types of things that are easier to understand what's going to happen in the next 1 month than what's going to happen in the next 3 months. And that's why you're going to get more premium for the longer dated calls, because there's a lot more uncertainty. So the question becomes, what's better? Should you take less premium with more certainty, or should you take more premium with less certainty? And the answer is actually really simple. It's less premium with more certainty. And the reason for that is really because of earnings. Earnings is one of the biggest contributors to uncertainty when it comes to a stock price. So when you're trading 1 month calls or short dated calls, you can do 12 of them in 1 year. And we know that there are 4 earnings every single year for every stock. So when you're trading 1 month calls, 4 out of those 12 calls that you sell have uncertainty built in, or earnings. So 25% of the calls that you sell out of the year will be fairly uncertain. The other 75, you have a lot more certainty with it. Conversely, if you were trading 3 month calls, then every single one of those calls will have an earnings cycle built into it. So 100% of the calls you sell have uncertainty. So that's really why it's better to be on the shorter end of the spectrum and have most of your trades be uncertain, or most of your trades have a lot more certainty, and only a quarter of them have that uncertainty built in, versus having all of the trades that you do have uncertainty. So based on our backtest, it's better to be on the shorter end of the spectrum when it comes to selling cover calls because of that. And our backtests actually show that it's best to not even sell any cover calls when earnings are coming up. And we'll show you how Options Play helps you filter those out. Not only do we help you find what is the right trades to make based on your individual preferences, but more importantly, we show you if there's earnings coming up, we'll warn you of that. And based on our test, you want to generally avoid selling cover calls going into earnings. So that's talking about, we've back-tested cover calls of all different expirations, and that's been our findings. Now let's look at the strike prices. We've talked about 3 different selections: conservative, optimal, or aggressive. Like I said, I fall under the more the optimal end when it comes to risk tolerance. So what do those different calls look like? So when you're on the conservative end of the spectrum, meaning you're selling a call that's further out of the money, you're going to get less premium. if you're getting aggressive and you sell a call that's near the money, you're going to get more premium. And what are you trading off with that? The trade-off is really how much upside you're giving yourself on the underlying stock. So the strike price that you sell is where you have to sell the stock if the stock goes above that strike price. So how far out you sell, or how far out the strike prices that you choose, the difference is the upside that you'll get on the underlying stock. So the question becomes, what's better? Should you take less premium and give yourself more upside for your stock to continue running higher? This because the reason you're in the stock is because you think the stock's going to go higher, right? You're not buying a stock because you want to sell at the current price. So what's better, having less premium and getting more upside for it, or getting more aggressive and getting more premium every single month, but limiting your stock in terms of upside? And this is the interesting part, that a lot of people don't really, it's not necessarily intuitive as to what's best, because a lot of users that I see selling covered calls and a lot of the services that are out there, they're really going for nice, big, juicy premiums. A lot of the covered call programs that I see out there by other firms, they're trying to target 1.5% every single month in returns. So they're looking for more upside, and they're willing to give up that. They're looking for more premium, and they're willing to give up that upside on the underlying stock in order to get it. But based on our back test, it's better to have less premium and give your stock that upside to potentially go higher. And the reason for that is because the amount of money you can receive on a covered call is limited. It's limited to the premium that you receive. So no matter what, best case scenario is you keep all of the premium that you've sold. But worst case scenario is the stock shoots up and you're not participating in any part of it. So what that means is it's a negative risk to reward trade. So meaning best case scenario, your rewards are capped. Worst case scenario, your risk is unlimited. And it's not real risk because you're not losing money, but it's money that you've lost, because if you did not sell that covered call, you would have made that money on the stock shooting higher. So what we have found based on our test is that it's on the conservative end of the spectrum. Now, you don't have to be on the 10 delta calls. Based on our back test, anywhere from the 15 to 20 delta is perfectly fine. But you generally want to have less. What's more important is to give yourself more upside, and it's okay to take a little less premium up front, because a lot of times the stock will run higher, and you want to be able to take advantage of that stock appreciating. You don't want to get caught up where you're just trying to get a little bit more juice on the covered call, but you're giving away a lot more because the stock won't have that opportunity to run higher. So just to recap, what is kind of the optimal covered call strike based on our back test? When it comes to optimal, it's better to prioritize certainty over big premiums, meaning you want to do shorter dated calls where you have a lot more visibility into what might happen in the short run, than do long dated calls where you have a lot less certainty as to what might happen. And the other thing you want to prioritize is giving yourself some room for that stock to run higher, and prioritize that over income. And if you have that mentality with covered calls, you'll do better in the long run. So when it comes to expiration dates, we find that anywhere from 21 to 45 days is kind of a good sweet spot, because that's where you can do this month after month, and you can do it without including earnings for most of the calls that you sell. And then approximately the 15 to 20 delta, or anywhere between optimal or conservative, those two settings tends to be better for you in the long run, because you're giving yourself that stock the opportunity to run higher. And what we've seen based on our performance is that you're seeing approximately, on average, about 3.4% annualized return over all S&P 500 stocks over the last 10 years using a strategy like this. And that's in addition to what you're currently getting on your stock. So if you're getting a 10% return on your stock, you can earn approximately additionally 3.4% annualized return on top of that. Now, keep in mind that that's an average over 500 stocks. You probably don't own all 500 stocks in your account, so your performances may be completely different from these. This is an average over 500 stocks. So some stocks, you might get 10, 15% annualized returns. Other stocks, you might have negative or very small returns. So just keep that in mind. 3.4% is an average over 500 stocks over the last 10 years that we have found using this type of strategy. So with that in mind, like I said, we've tested all different types of stock. Not all stocks are the same. We have found that some of the best stocks for these types of strategies, which is typically the stocks that you hold in your account for long periods of time, is blue chip, low growth, high dividend stocks like GM, Blackstone, Citigroup, AT&T, Walmart. These types of stocks are tend to be best performing when it comes to covered calls because there's not a ton of volatility, there's not a lot of big jumps one way or another, which is usually what causes large underperformance in covered call strategies. And some of the worst stocks are mega cap, high growth, low dividend stocks like Apple, Bank of America, Facebook, Amazon, Priceline. These are a lot of these tech stocks that have huge growth potential, are usually the ones that are worse for covered calls because covered calls limit the upside return, and you generally don't want to limit the upside on some of these high-flying stocks. A lot of times you own these stocks because they appreciate in value very, very quickly. So just keep that in mind. Based on the different stocks in your account, you might want to adjust your strategy for each individual stock. So with that, let's talk about how can you actually implement these strategies for your portfolio very quickly using options flow. For that, I'm just going to bring up options play. For those of you that are new to our platform, welcome. I'll just give a quick snapshot or a quick overview of the platform itself for those of you that have never seen this before. This is the options play tool. If you sign up for a free trial, you'll be able to see this exactly as I have on my screen. It divides into 3 sections. We have trade ideas and watch lists on the left. We have our equity analytics panel here in the middle, and then we have trading and income here on the right. We call these 3 panels the what, the why, and how of options trading. And what you have is trade ideas and watch lists. This is essentially what symbols should you be taking a look at. We have fresh trade ideas every single morning scanned for you, or you can create your own watch list, which we have pre-built ones based on the sector ETFs. For any symbol that you type in, we'll be able to present to you we have different tools that are designed to help you understand what the current trend of the stock is and what the strength of each stock is, so you can see what the 1-month and 6-month trend of the stock is and how it's changed over time. As you can see, IBM was quite bearish over time, but here in late August, the 1-month trend started to turn neutral, and just actually a couple of days ago turned mildly bullish, and it looks like it's just about to break above this 145 resistance level. But as you can see, a technical score of 2, this is telling me that on a relative strength basis, this is a very weak stock. But perhaps it might be starting to bottom out and turn around. So this is some of the tools that is given to you so that you can quickly see this is a weak stock, but maybe it's starting to bottom out and the trends are starting to turn positive. It's a little too early to tell on this particular stock, but this is just the power of the tools that are available to you. Below, we have things like earnings, dividends, and price action. This is designed to help give you the data that you need to make option trades or make option decisions all on one screen. So I know that there's earnings in the next 34 days. So if I'm selling a covered call, I want to be cognizant of when that next earnings is, because I generally want to avoid selling covered calls into earnings. It allows me to know what the dividend is, when the next dividend is, as well as price action. And then lastly, we have trading and income. This is designed to quickly give you a snapshot or a starting point of what to do regardless of what your views are on the stock. So if you're bearish on the stock, we'll present to you 3 bearish strategies that you can take: shorting the stock, buying a put spread. If you're bullish, you can buy the stock, buy a call spread. That's not what we're here to talk about today. We have a whole nother webinar just on that. Today we're going to be talking about generating income. So if you own IBM stock, what can you do to generate some income? So before I get started, when you get onto options play, if you're looking to generate income, first thing you should do when you click on the income tab is go down here to where it says default settings. So like I said, we were talking before, there's 2 things that you need to choose: an expiration date and strike price. And that really comes down to what your preferences are and how frequently you trade and what your risk tolerance. Like I was saying before, my frequency is on the short end of the spectrum because I'm a fairly active investor, and I like to be on the optimal track when it comes to risk tolerance because I'm looking to seek a balance between risk and reward. You might have different preferences, you might have different settings, but you can use these tools to help you create what setting suits you. So if you're a long-term investor and you like to be very conservative, you choose those settings, whatever they are, you just click on Save as Default, and we'll show you how you can do this very quickly. So like I said, I'm short-term optimal. You choose whatever suits you, save as default. Now, for any stock that you type in, let me go to my watch list real quick. For any stock that you type in, now what we're going to do is instead of going through the chains and picking an expiration and strike price, we do all of that work for you. Let me use a different symbol real quick just for now. So let's say I own Intel. I'll come back to Coca-Cola in 1 second. So let's say you own Intel. One of the first things on the income tab is it asks you, do you own shares of Intel? Click on yes. Enter the number of shares of Intel that you own. And what it does is it shows you exactly where your optimal starting point is based on your settings, which for me was short-term optimal. So this is telling me based on my settings, if Intel was trading at 36.33 right now, it's telling me to sell the October 27th 38.5 cover calls. So that's the call that's about $2 out of the money, roughly $2 out of the money. It gives me an annualized return of about 4%. Now this is a stock that currently pays a 3% dividend. So that means that I'm getting 3% by holding onto the stock, but if I add this cover call to my trade, now I'm getting a total 12-month yield of about 7%. So 3% on the dividend, 4% on the cover call, that gives me a total yield of 7%. Great, this is a trade that I'm going to be probably taking a look at, and it gives me an 83% chance that this call is going to expire worthless. If you remember before, for the optimal track, I want to sell cover calls that have approximately an 80% probability of expiring worthless, or a 20 delta call. Now, what this does is it not only goes out there and finds that 20 delta call for me, but it brings all the analytics so I can very quickly say, what is the yield on this? Is this high enough? If it is, great. All I have to do is hit the trade button. And then what we have is a strategy checklist. Now, as you can see here for Intel, it's telling me that I have a good probability of expiring worthless, which is good. It's telling me I have an annualized return of 4%, which is average. And this is telling me that beware that there's earnings on October 26th. So this is telling me to sell an October 27th cover call. So this is telling me there's earnings between now and expiration. It's just 1 day before my earnings. So maybe I might still want to make this trade, maybe I don't. That's up to you, and it's telling me the bid-ask spread is relatively large. So this is a trade that I'll, based on these decisions, decide whether I want to trade or not. But it's giving me all the data instantly just for typing in the symbol. And I can do this for any stock, and this is designed to save you guys time. We say that we can help you find a cover call in under 15 seconds for any stock that you choose, because once you put in your settings, we'll tell you where you can start. So on Tesla, let's say Tesla's trading at 366. Let's say you own 100 shares of Tesla. This is telling you to sell the October 6th 395 cover calls. So again, I don't have to pull up that option chain, go looking for that 30-day call, find the 20 delta call. It already does that work for me, and it brings up all the analytics. So Tesla pays zero dividends. So meaning if you own this stock, you're getting 0 yield. By adding a cover call to it, you're getting about 11.5% yield. So you're increasing your yield from 0 to 11.5. So certainly a trade that I want to entertain. 83% chance that this call is going to expire worthless. Click on trade. As you can see, good probability of expiring worthless, good annualized return, no earnings between now and expiration. So it ticks all of those boxes. And the last thing is telling me the spread and liquidity is not very good. So I have to be careful when I enter my order. But I got all the information that I need in order to sell a cover call on Tesla without having to ever pull up a chain or do a lot of research. It provides me with that optimal starting point in under 15 seconds, and I can make a decision as to whether I want to sell a cover call on this trade or not. And this is what the power of this tool, because if you set up a watch list with all the stocks that you own, you can go through that list within a few minutes and know exactly which stocks have cover call opportunities and which ones don't. Let's just go through a few more examples here. Johnson & Johnson, stock that a lot of you may have in your account. 132.45 is what it's trading at. This is telling me that, let's say I own 200 shares of the stock. This is telling me that I can sell 2 contracts of the October 6, 136 cover calls. So a cover call is about $3.50 out of the money. This stock currently pays a 2.5% dividend yield. So nice dividend on a stock, but as you can see on my annualized return on this cover call is 3.5%. So this increases my total yield from 2.5 to about 6%. And again, telling me that I have about an 82% chance that this call is going to expire worthless. And I can click on trade, look at my strategy checklist. It tells me that the probability of expiring worthless looks good. The annualized return is average, which is okay for me, and there's no earnings between now and expiration. So I have all the relevant information I need before I go ahead and enter this trade. And for those of you that want to enter this trade, it gives you all the details you need in order to enter this trade properly in your brokerage account. So it tells you to sell to open 2 contracts of the October 6th 136 call, and your premium is about 29 cents per contract. So again, you can very quickly see how this becomes very powerful, because once you set up your watch list, you no longer have to spend the time going through the chains, looking for the proper expiration, looking for the proper strike price, then entering those details into a calculator so you can calculate the yield, look at earnings dates perhaps on a different website. This is designed to save you time. So all the information you need to place a trade is available to you at your fingertips. So let's just look at Apple, another popular stock a lot of you have in your account. Apple's trading at 159.5. This is telling you to look at the October 6th 167.5 cover calls. Again, this is based on my settings of short-term optimal. If you have different settings, it'll spit out different cover calls as a starting point for you. And this is telling me on this cover call, I'm going to get about a 7.5%, 7.75% yield on this cover call on a stock that pays a 1.5% dividend. So this increases my total yield to 9.3% with an 84% chance that this call is going to expire worthless. And when I hit trade, I'll go through the strategy checklist. It tells me I have a good probability of expiring worthless, good annualized return, and there's no earnings between now and expiration. And spread and liquidity is okay, so it's telling me that these are the details for me to enter into my brokerage firm, so I can very quickly get into an order in and place that trade. So what I've shown you so far is how the power of this tool, how much time it can save you in finding the right opportunity to sell cover calls. And by doing this, you're going to avoid mistakes as well, because you're not going to look at other expirations and try to chase a fat premium just so a lot of times what you do is when you're looking at that chain, you might say, oh, 78 cents doesn't look really good. I'm going to try to get $1 from another strike. And you can do that. So if you want to move that strike down, so if you go down to the 165 strike, one strike going to get $1.25 per contract. And that sounds more attractive than getting 78 cents, right? However, that starts to deviate away from what works. If you remember, what we're showing you is that giving your stock more upside to appreciate in value between now and expiration should be a higher priority than getting fat premiums. That extra 50 cents is not worth giving up $2.50 on the stock, because if you sold a 165 call, you're limiting your stock to above 165. For some of you that are okay with losing the stock, that's fine. You can make these adjustments. But for most of you that want to hold on to that stock and you're looking for consistent income in the long run, you're better off sticking with what works, which is giving your stock more upside. So giving yourself enough dollars upside for just 50 cents less in income. That's what we've shown over the long run works. So just to give one last example, sometimes you'll come across a stock that looks like this. So notice before all of these, I get this green check mark. On Coca-Cola, it's a little different. This is telling me that I could not find me a call that met my criteria, which again was short-term optimal. This is telling me that the next best alternative it was able to find me is a long-term optimal. So for me, I generally don't like to sell cover calls that are outside of my range or my preferences. You can do that if you want. You can click on the options grid and you can see what else is available. So if you can see, if I want to do an October call, I have to get really aggressive. I have to go down to the 47.5. That's only about 70 cents out of the money, and I'm only going to get 28 cents in premium for that. So for me, that's not worth my while. So this is telling me that I can make other choices if I want, but I'm not comfortable selling a November call that's only $1.10 out of the money. So if I click on trade, as you can see, the probability is not good. The annualized return is just average, and there's earnings between now and expiration. So this is not a trade that I would like to make. But that's the power of this platform. It gives you the other opportunities if we couldn't find you something that meets your criteria exactly. But for most of you, you might just move on and say, I'm not going to sell cover calls on Coca-Cola. I'm going to look at the next stock. So that's really what this tool is designed to do, not only help you find the right one, but help you avoid bad trades. Because if you were trying to sell a cover call on Coca-Cola, you might have pulled up that chain. You might have saw the 48s, 48 and a halves, which are probably the 20 delta calls, just don't have enough premium. Let's take a look. So if you go for the 82% probability of expiring worthless, which is the 48 and a half calls, it's only have an 8-cent premium. So you might say that's not enough. Let me get a bit more aggressive, and you might end up selling the 47 and a half. But look at that. That only has a 64% chance of that call expiring worthless. Is that worth 28 cents? No. Based on our back test, it's never a good idea to take something with such a low probability for such small yield, only a 5% yield with a 64% chance that this call is going to expire worthless. Not worth it on a stock that already pays a 3% dividend. So this is designed to help prevent you from making bad trades or bad decisions, because when you're staring at that full chain, it's hard to tell which one's the good one, which one's the bad one. By filtering out the chain, you can make a much better decision as to which trades, which stocks you want to sell a covered calls on, and which ones you don't. Taking a look at Sprint. Same thing. On Sprint, I couldn't find me a covered call. Sprint's a very low price stock, so your chances of finding a covered call is lower to begin with. And this is telling me that I have to go all the way out to February before I can find some stuff with some yield. And again, not something I want to do. So this saves me time. I don't have to bother pulling up the chain for Sprint, looking at it and deciding that, hey, this is not something for me. I'll just move on to the next stock. And I immediately know on GILD what my cover call strategy might be on GILD. And you'll see how quickly you'll be able to go through your portfolio and within a matter of minutes know exactly which stocks have cover call opportunities and which ones don't. And remember, once you've honed in on a trade that you want to make sure you click on the trade button. Go through the strategy checklist. Make sure that there's no earnings between now and expiration. It's an extremely important exercise before you go ahead and place a covered call trade to understand what your risk is before you place that trade. So that covers kind of how you can use our platform to help you very quickly identify income opportunities on all the stocks in your portfolio. So I'm just going to go back and talk a little bit about exit scenarios, because most of you have, at the beginning of the trade, beginning of the call, most of you have answered yes to selling covered calls before in your portfolios. So a lot of times you get questions about what should you do once you're in that covered call. So I'm going to go over 3 different scenarios, meaning once you sell that covered call, what happens? First scenario, which is probably the worst one and where a lot of people don't know what to do, is if you sell a covered call and the stock shoots higher. Maybe it goes to the strike price, maybe it goes a little higher above the strike price. What do you do? And the answer really is don't panic. Don't go out there and just buy back the call because you have a large unrealized loss on that covered call. Best thing to do is actually hold onto that covered call, see what because number one, you want to give the opportunity of the stock that runs up very quickly higher. It might come back down very quickly as well. You want to give it some opportunity to potentially fall back lower, and you want to take advantage of the time decay of that covered call that you did sell, and the only way to do that is hold it towards expiration. And if you have to roll that covered call because it's above your strike price, do it within the last week, because at that point you've now captured that time decay, and then you can now roll. If you roll too early, you're essentially locking in a loss for that trade. So you don't want to you never want to lock in a loss. So if you can, hold on to the trade, hold it till about a week from expiration, and if you have to roll within that last. Next scenario is kind of probably the most ideal scenario, where the stock just goes sideways. In this particular case, you generally just want to hold up onto your covered call, let it expire worthless, and sell it again. So that's pretty straightforward. Lastly, if you sell a covered call and the stock goes much lower, this is the only time where you want to roll your position early. So if you can buy back a call that you sold for $1 for 10 cents, 20 cents, you want to buy that back as early as possible and sell another covered call immediately. That will increase your probability of decreasing your cost basis on the underlying stock as quickly as possible, because if the stock moves lower, you are taking a loss on the underlying stock, so you want to buy as much downside protection as possible by selling an additional covered call. That's what we call hitting doubles, because selling covered calls is really just hitting singles and doubles. You're not hitting any home runs when you're selling covered calls. The only thing that can happen is you sell a very aggressive call and the stock goes much higher above your strike price, and that's kind of the worst case scenario. So keep that in mind. Give your stock room to the upside, but if the stock falls, that's the only time where it makes sense to roll early in your position. So with that, what I'll do is I'll open this back up for Q&A. For any of those of you that have any questions, I'll scroll up because I think there was a few questions during the webinar, so I'll go through some of those. And for those of you that have questions, feel free to put them into the chat window or the Q&A window, and I will answer them in order. And if you have any specific stocks that you want to take a look at, shout them out and we'll go through them. So Danny is asking, what in your time frame or annualized return? I'm sorry, I'm not sure what that's referring to. Danny Smith, if you can elaborate on that a little bit, I'm happy to answer your question. Michael is asking, is the annualized return calculated on 12 months of selling or skipping the earnings month? So Michael, a good question. It's calculated based on selling the full 12 months, the annualized return. Ned's asking, can you briefly discuss a buy right? A buy right is the same thing as a cover call, but you're just buying that stock when you're selling that cover call. And that's a strategy that some investors do, where you identify a stock that you think is very strong, fundamentally speaking, or you think is going to appreciate in value in the short term, and what you're doing is instead of already owning the stock, you just basically buy the stock and sell the cover call. So if, let's say, you own 0 shares of the stock for 1 second, you click on trade. Let's see if I can do this. Here. So let's say you own 100 shares of this stock and you want to sell a cover call on top of that. So whatever strike that you choose, so if the stock's trading at 83, let's say you want to sell a 90 strike or an 89 strike. So this is essentially a buy right, where you're owning the stock, or you don't own the stock, but you stock and selling the cover call at the same time. It's the same concept, it's just that you don't already own the stock. Lisa's asking, can you go over selling naked puts? So this is not what the webinar was designed for, but I will go through that very quickly because a lot of you are interested in this strategy because you might want to generate income on a stock that you want to own that you don't already own, and this is a very popular strategy. So let's say I really like Apple, but I don't like it at $159.60. I think it's too much to pay the current price, but I still want to try to generate some yield. One of the things that you can do is when you go to the income tab, if you see here, it says own shares of Apple, and you click on no, it will give you a put opportunity. Now, before you look at short-term puts as well, you also have to use the settings to create what are your preferred settings for puts. So for me, I like to get pretty aggressive when I'm selling puts because I usually want to get filled on the trade and I want to own the stock. So I have my settings for puts as short-term aggressive. So this does the same thing. A short put is very similar to a cover call and risk profile. And what it does is essentially lets you buy the stock at 155 if the stock is below 155 on October 6th. And in do so for doing that, you're going to receive some income. And generally speaking, the yield on short puts is usually pretty good. So as you can see here, if I sold an October 6th 155 put, I'm getting a 13.5% annualized return. So this is an alternative to buying the stock. There's a large cash requirement in order to do these types of strategies. So because if the stock goes below 155, you essentially have to purchase 100 shares of it. So you have to set aside quite a bit of cash in order to do these types of strategies. But it's a great way to acquire the stock at a lower cost basis if you do want to buy the stock, but you don't want to buy at the current price. So a great question. You should definitely take a look at those strategies if it's a stock that you don't currently own and you want to own. Thanks, Lisa. That's a great question. Frank's asking about spreads. Like I said, that's a subject for a completely different webinar, but for those of you that are interested in trading spreads, we have a whole tab dedicated to it under the trade section. It'll give you ideas for, if let's say you're bullish on Apple, you can show you buying the stock, buying a call, buying a spread. and all different types of tools here to show you how those strategies perform. If the stock goes higher, if the stock goes lower, for any scenario. So you can use this tool not only for income generation, but for those of you that want to trade directional views, use this for spread trading as well. Gil's asking, can you explain max reward? Yeah, so max reward is how much upside you could potentially have on the stock. So like I said, when you're selling a covered call, you're capping the potential reward of that stock above that strike price. So that's why it's very important for you to select strike prices based on your appropriate risk tolerance. So max reward is telling you how much more money the stock can make above the current price to that strike price is essentially what that max reward is telling you. Lisa's asking about the options play score. Again, this is getting a little off topic, but I'll talk about this. So when we talk about these trading strategies, a lot of times some strategies will give you a max reward of unlimited or max risk of unlimited. And what we realize is that most users don't know how to compare a strategy that has unlimited max reward to a strategy that has max reward of 772. It's virtually impossible to do that. So how do you actually determine what is the risk reward of a trade, and how do you compare them between different strategies? That's why we created the options play score. This is essentially looking at your potential opportunities for reward and risk on each strategy within a predefined range. So instead of saying that the stock's going to go to zero, the stock's going to go to infinity, we assume that the stock's going to stay in a reasonable range, and we calculate the risk reward of each strategy within that range, and that's what the options play score tells you. So it gives you an idea as far as what the true risk reward of a strategy is, and it puts the three side by side so you can make a comparison apples to apples, even if they're completely different strategies, and you get an idea as far as what the risk reward is, and they're color coded for you so you don't have to memorize what's good, what's bad. You just have to know green is a good risk reward, red is bad, yellow is somewhere in between. So thanks, Lisa. But I'd like to get a little bit back towards the income side. Any questions regarding the stuff that we've covered today with income strategies, with best practices? Feel free to ask them. I have a question here by Bob saying, how do you use the new window screen in upper right of covered call income window? Not sure what you're referring to, Bob. So when you click on the income tab, you don't have to do anything. You just type in the stock, and it will automatically populate the strategy that best fits your risk profile and your preferences. So for me, it's short-term optimal. So when I type in Goldman, it tells me to sell the October 6, 235 covered calls. Goldman's trading at 226 right now, so approximately $10 out of the money, and it gives me the breakdown of all the details of the trade, such as what is the return of this trade, what is the probability of this trade expiring worthless, and when I click on the trade button, I get all the details that I need in order to figure out whether this is a trade that I'd like to make. And Michael's asking a great question. Does your software track option positions you own? It currently does not, but this is a tool that we have already built for financial advisors to help them track their cover calls, and we're going to be releasing that to the general public October 1st. So for those of you that have a subscription with us, you'll receive an invite to that preview of that portfolio tool. That is a tool that not only helps you find that covered call, but actually manages your portfolio for you. So all the scenarios that I talked about before in terms of the exit scenarios, we'll actually be able to scan your portfolio and let you know if it's time to roll a covered call or get out of it because you've made enough money. So that's a tool that, like I said, we're going to be launching on October 1st for retail customers if you have a trading account with us. Thanks for that question. Ray's asking poor man's covered call. Very interesting trade. So for those of you that don't own 100 shares of that stock, can you still sell a covered call? And the answer is yes. What you can do is you can replace buying 100 shares of that stock with buying a leap. So if let's say you own, so Goldman, to buy 100 shares of the stock costs $22,000. So instead of paying $22,000 for 100 shares of that stock, what you could do is you could, let's say, let's go out to June 2018, and let's buy a deep in the money call. Let's say buy 200 strike, or maybe even a 185 strike. Let's say we buy a 185 strike, $4,720 as opposed to $22,000. So about a fifth of the price to buy a deep in the money call. And what you can do is you can, instead of, as you can see, the risk profile of this long call and the stock is almost identical. As you can see here, I have a break-even price of 226. I have a break-even price here of 232. Risk to reward is very similar to each other, but risk is limited to $4,700 because that's what I've paid. So if you, instead of owning 100 shares of the stock, you own this June 185 call, you can sell cover calls against that call as well. So you can go to the income tab. This is telling you to sell the October 6, 235 cover calls. So what you can essentially do is buy that June 185 call and sell this October 6, 235 cover call against it. So that's really kind of a poor man's cover call. Great question, Ray. Thanks for that. Question here by Martin. Will your program search for best income spreads, such as ratio spreads or back spreads or butterflies? So we offer all of those types of trades as well on the trading tab. So if you click on modify under any of these, we have a strategy constructor. We have templates for about 50 different strategies here. So if you want to look at back spreads, you can do them. You can look at ratio spreads, butterflies, neutral strategies, condors, butterflies, all types of strategies. And this is all designed so that you can switch the strike prices and expirations very quickly, all by just a click of a mouse. So that's all available to you under the Trade tab. Is there a way to see delta? Absolutely. So if you click on the Income tab, or any strategy rather, at the very bottom, so let me just show everyone. So if you're looking at a specific trade and you want to find the delta, there's a little blue button here that says Expand. And when you click on that, at the very bottom, it says Explain Strategies in Greeks. So this will actually tell you the delta. So it'll tell you what the delta of each trade is in this particular case. So for any stock that you, or any position that you click on, so if I'm looking at October 27, 225 calls, I click on that blue button, Explain Strategy in Greeks, I can see what the delta is. But more importantly, what we do is we explain the Greeks to you in plain English, which I think is a little better than just telling you what the Greeks are, because this will tell you how much money you'll profit if the stock goes higher. It'll tell you how much money you're losing to time decay, which is really what you're most interested in, and we explain it to you in plain English. So especially if the Greeks are really a little foreign to you, use the English version in order to help you interpret that. Great question. Thank you, Edward. So any more questions? Ray, I have a question here saying risk PMCC. I don't know what that means. If you could clarify, that'd be great. Any other questions regarding what we talked about today with the income strategies? Lisa's asking if this webinar is recorded, and it absolutely is. And once we finish processing this recording, we'll be sending this out. It'll be probably tomorrow morning when we send it out. So if you're registered for this email, for this webinar, you'll receive the recording tomorrow morning. Oh, PMCC, poor man's cover call. Yep, that's exactly. Thanks, Ray. Any other questions regarding what we went over today? Martin's asking, how deep in the money is preferable for LEAP poor man's cover calls? I usually like to buy a call that's about one standard deviation down. So let me just show you. So when you're on the trading tab, do you have a stock that you want to look at? So we look at Apple. So one standard deviation is roughly the, here, I'll show you. So Apple's trading at 159.60. Let's say you want to go out to, I don't know, June of 2018. When you go to the strike drop-down, as you can see, we have the 1 standard deviation move marked off for you. So I would say roughly this 125, 130 area would be where you'd want to buy a deep in the money call. So let's say you buy this 130 call. So as you can see here, buying 100 shares costs you almost $16,000. Buying this deep in the money call that's about 1 standard deviation down costs you $3,000. So again, roughly about a fifth of the price. And what does that delta equate to? It is the 81 delta call. So so I would say 80 to 85 delta is where you'd like to be if you're trying to trade a deep in the money call for a poor man's cover call. Michael's asking if we'll talk about covered strangles. We won't have one specifically on strangles, but the covered strangles, or what we call a covered combo, is really just a combination of these two. So if you own 100 shares of Apple, not only could you sell the October 6, 167.5 cover call, but you can also sell at the same time the October 6, 155 puts at the same time. And the risk is different because you get the same cap on the upside, but if the stock goes below 155, you have to purchase another 100 shares. But if you want to do a covered strangle, you can use this tool exactly just for that, selling that cover call and that short put at the same time, doubling your yield, or more than doubling your yield, because you're getting a 7.75% yield on the cover call, a 13.5% yield on the put, combined yield of roughly a little over 21%. So if you want to do both, absolutely, this is a popular strategy for more advanced traders that want to buy more of this stuff. Ray, I'm still not sure what you mean by risk of poor man cover calls. If you can elaborate, that'd be great. Any other questions regarding what we've discussed today? If not, I want to thank everyone for taking the time out this afternoon. Like I said, just when you think about cover calls, don't overthink it. Use the tools that we have built for you here to help you fine-tune help you find your cover calls. Just use the default settings here at the bottom of your income tab. Choose your desired time frame and your risk tolerance. And once you save that as default for any stock that you type in, we'll go out there and do that work for you, present to you all the details that you need to decide whether or not you want to place a trade, and use that as your guidance and as your starting point. Ray is asking risk to reward of poor man's cover call. I'm not sure what you're referring to. The risk is the same as your cover call, just that your absolute risk on the downside is what you paid for the leap, as opposed to for your cover call. So the most risk that you're taking is effectively the premium that you paid on the leap minus the premium that you receive on the cover calls that you sell. All right, thanks everyone. I hope you guys found this useful. Like I said, this webinar will be recorded, so you can review this at any time afterwards. We covered a lot of things today, so make sure that you take a look at the recording and go over some of the data that we went over today. I want to thank everyone for taking the time out this afternoon. I hope you found this helpful, and I'll see you guys at the next webinar. Thanks so much for joining. I'll see you guys soon.